I'm joined with Florian Grummes. Florian, it's great to finally meet in person.
Exactly. Thanks for having me.
So we're here at the Beaver Creek Precious Metals Summit, and I have to say, gold is hitting all-time highs. I think it's hit them on 12 of the last 14 days, or 13 of the last 14, or something. I mean, that could change. What's going through your head right now when you're thinking about gold?
Well, I mean, there's always a lot of topics related to gold we can talk about, but it's been a heck of a run the last 2.5, 3 weeks. It's not long ago that we had an interview, and around that time, gold finished its 4 months consolidation, right? And here we are, $360 higher from the low in mid of August, 3,311. Yesterday, new all-time high, 3,675. Strong rally. Many of the smaller mining stocks catching up. I gave a keynote yesterday here at the conference, and I laid out the 4 macro drivers for gold, which I don't think will change anytime soon. I think they will stay in place for the next 1, 2, 3 years probably.
So what are those 4 macro drivers?
So first of all, you have the central bank buying. Since the invasion of Russia, it's very obvious for many emerging markets nation, but also for the big ones like China. Russia is doing it for many years already. The central banks buying gold, trying to dollarize, move away from the dollar, moving away from euro, diversifying themselves. That's a trend in motion. It will not stop anytime soon. The second big driver is China, of course, the massive demand. The Chinese love gold. This is also not changing at all anytime soon. And instead, I think it's just intensifying. And then the third driver, in my opinion, is liquidity. If you look at the M2 money supply in America, it's going basically straight line up. The same is true for the Eurozone, for the European Union, as well for Japan, China. They're all printing money, basically. They're all expanding the money base, the liquidity, and that's what's driving all the markets. It's not only the precious metals and gold, it's driving your real estate prices, your groceries, your stock market investments, everything. And the fourth driver is the bear market in the bonds. So I think, especially for institutions who play the longer end of the bond market, the bond market is in a bear market. It's difficult to hold a long dated bond nowadays. And where can they go? Yeah. If they seek a safe conservative asset, the only alternative is gold.
Yeah. To your point, I mean, you buy bonds, you might get, let's say in some cases up to a 5% return, and inflation, it's starting to look like it's going to come back and rear its head here with all the money printing, the tariffs going into effect in the US is certainly going to drive some level of inflation. Other countries now have huge holes in their GDP that they're going to have to fill. We've already seen it in Canada recently with announcements from Mark Carney, basically bailing out all of these companies impacted by tariffs. And I don't really know what the solution is. We're going to give them money, and I don't know how that's going to fix anything other than keep them afloat for maybe a year, and then we cross our fingers and hope that the tariffs go away, which, I mean, I think it's kind of foolish. $5 billion is a lot of money. People don't realize it, but Next Gen Energy, who's the largest undeveloped uranium project in the world, if you go and read their feasibility study, they will, once that goes into production, now this doesn't include the taxes collected by the workers, but that project amounts to $5 billion in taxes for the government. So it's like we just randomly insert the stimulus, and that offsets one of our top bullets that we can shoot in terms of economic development and productivity. And I think that we've gotten to the point now where everybody's just sort of like, whatever, just print as much money as you want, and they don't realize that there's consequences to these actions.
Oh, of course. No, you're making a very good, valid point. I can tell you similar stories from Germany. I mean, the German car industry is in free fall, and yet they just printing money to keep things afloat. And I mean, there's no real understanding of the economic background. There's no real willingness to change things, and they're just muddling through somehow. And the end result is higher prices in your supermarket. And a vast majority of the population in really a dire, difficult situation.
Creating zombie companies.
And zombie cities especially, right?
I believe that, and this is when I really became a gold bug, was when I first heard Ben Bernanke say the words quantitative easing, and I know I say it in a lot of my interviews and videos. To me, that's where the whole game changed. And at the time, gold kind of ripped immediately, and then it came down. You know, it went up to like, I don't know, it was $1,900, came back down to say near 1,100, and then it eventually worked its way back up. And the market had it right at the time when people were buying; they were just early. And now we see that impact because now governments just basically, who cares? $5 billion for a bunch of zombie companies that aren't gonna. It's not like Carney literally, and I know you're not from Canada, so I'm sorry for ranting about this, but he talks about giving $5 billion to the tariff impacted businesses, and literally 3 days later, they're talking about removing their tariffs on Chinese electric vehicles, which will largely uh, undo that. They're just going to make it far more difficult for those companies he just gave the $5 billion to compete. But when Ben Bernanke said the words quantitative easing, everything changed, and governments just got to the point where they just spend money. Who cares? We'll just print it, and that's brings us to, I guess, $3,600 goal today.
Yes, it does. But I think really the most important driver is this physical demand from the central banks and China. And of course, the gold plays a geopolitical role. Obviously, China wants to become the number one on this planet, and they're moving away from the dollar. And what it really means is that 55 years, more than 5 decades of paper Ponzi scheme kind of fiat money systems in the West, especially in England and in America, is being unwinded now. And we are used to that 200 paper ounces of gold are doing the price discovery of 1 real ounce of gold. That's what happened over the last 5 decades. And this is being unwinded now. And that's why you see these sharp moves. And I think to a large extent, this is also a short covering of all these paper gold products that have been sold over the last few decades. That's what's really going on.
So, Florian, last question for you. We were talking about it pre interview. I asked you what companies you were talking to, which ones were interesting. I'm not going to ask you to put your neck on the chopping block and name any, but what's the criteria that you're looking for if you're going to open up your brokerage account and make a trade right now? What are those names you're the kind of names you're looking for?
The most important criteria for me is management. You want to see a track record, a good one, ideally an outstanding one, because you have to remember only 1 in 1,000 of these projects are actually becoming a mine. The rest somehow faltering, disappearing, got taken over, whatever. Only 1 in a 1,000 is actually the percentage. So management is key. Jurisdiction is also very important, of course. The quality of the project is important. But with technology, I mean, you see that lower grades nowadays are still very attractive. In the first bull run, 2001 to 2011, it was not possible to convince investors with low grade. That has changed. When it comes to jurisdiction, I primarily focus on North America, but also South America, so the Americas. And to an extent, a little bit also interest in Africa, but it's still very challenging in some of those countries. And it's hard to do your due diligence on those. So these are the most important, basically, things that I check. And then, of course, I don't like to buy into a stock that has run up already to 300%, even though you might miss still a large chunk of the move that is ahead of us. But it's just hard to construct a low risk idea around the stock that has already moved 100 or 200%, even though it's fundamentally maybe still very undervalued, you know?
So, just deducing what you said, it sounds like you are looking for quality names that haven't moved yet, that you think have the potential to this time next year. You chat with, and you look at that return, and it's that plus 200, plus 300%.
Again, I mean, I've been already a little bit cautious yesterday in my keynote. But I think if you have done your homework and you really like a specific company or a specific stock, technical analysis is also very important, even in these smaller kind of markets. And you need to wait for a pullback. You need to, in a bull market, your job is to buy a dip. And that means you have to be patient and not freak out when it feels like the train has left and everybody's making money and you are not on board, right? You have to be patient. There will be pullbacks, there will be volatility. There will be also coming a point in time over the next few months, I'm sure, where gold suddenly looks a little bit like, wow, we had a $200 down day and miners losing 10, 15, 20% on that day. And that might be already a good point of time where you can start buying or adding to a position. But buying into these spikes it's not what I like to do, obviously, because it's not only me. There's other people also then buying into it, and then suddenly you get those type of pullbacks and corrections, and then you have a lot of weak hands in the stock, and that's what I want to avoid. So if you are not invested now, I think you have to be a little bit patient. It's very hard right now to find names that have not moved yet and are still good quality. It's really challenging. My other challenge right now is let your winnings run, pay yourself when the market makes money available. So of course, many stocks have moved nicely, sitting on nice gains, and it's the idea of letting them run and making them into a 10 bagger, of course, is beautiful, but in reality is also challenging because we also know how quickly markets can turn around or gains can disappear very quickly again. So I'm scaling out in some positions. That doesn't mean I sell the whole thing. I sell, maybe I take 5, 10, 15% off the table, because money management, position sizing, risk management is also a very important part of your investment strategy.
All right. Well, Florian, thanks so much for sitting down and doing this.
Pleasure. Thank you very much for having me.